Hello everyone, I'm Lawrence Kiddle, the Managing Director for Thomson Reuters Corporate Markets in EMEA and the Global Head of the Thomson Reuters for FATCA Solutions. And just like to say welcome. It's great to have so many of you joining us for the webinar today, and thanks for joining us. So it's my pleasure to moderate this webinar, which is on the unintended consequences of FATCA as they affect wealth managers. And to lead the discussion today, we've got Lon Fairbrook and David Gunson. Lon's had the pleasure of going through the FATCA registration process firsthand. He's an expert on the interaction between pensions and FATCA and founded the Fairbrook Alliance, which focuses on international retirement planning. David is a tax law specialist who's based in Hong Kong with over 30 years' experience. He's a pension specialist and will discuss the interface between FATCA and the pension secrecy laws worldwide. And in a few moments, I'll hand over firstly to Lon and then to David. But first of all, just a few housekeeping points. All participant phones will be muted throughout the webinar. There is time set aside for Q&A after the formal presentations. And in order to raise questions for this, please submit them through the Q&A window. And if you are watching the webinar and following us in the full screen mode, there's a question mark icon in the lower right-hand corner of your screen that you can use. And then we'll collate the questions and we'll put them to, or I will put them to Lon and David at the end. Can't guarantee to ask every question, but please do raise them, and we'll do our very best to get through as many of them as we can. I think that's it from me for the moment. So the next time we hear my voice will be going back into the question and answer session at the end. In the meantime, now to hand over to Lon. So Lon, the floor is yours.
Well, Lawrence, I actually spoke to Matt yesterday. He told me he's very familiar with FATCA, which is why he is going to have his wife be the owner and director of his offshore internet marketing company. He won't even be an employee. Matt is a U.S. passport holder, living in the EU country of his wife's passport. And furthermore, Matt told me that in his EU country of residence, he and his wife are going to the court to establish a legal separation of their assets so that he won't be attacked legally or attached legally to his wife's business. Lawrence, Matt is drowning in ignorance. I told Matt his first step out of troubled waters is to attend this webcast. This webcast will make no recommendations to Matt. It will make no recommendation to anyone listening. There is no intention of this webcast to provide legal or tax advice. Nothing in this webcast is to be used for legal or tax purposes. The purposes of this webcast is to provide massively important reasons for further study of the issues that we are presenting. The information is not my or David's opinion. All information can be referenced directly in FATCA, IRS tax codes, guidelines, documentation, U.S. Treasury, intergovernmental agreements, and other governance. The unintended consequences that affect wealth management is about how both U.S. persons with foreign accounts and non-U.S. persons who are transferring capital in U.S. dollar can structure themselves to benefit from both the consequences and the unintended consequences of the Foreign Account Tax Compliance Act. FATCA is an information gathering exercise, a consequence of which is to find passive foreign investment companies, which are often referred to as PFIC, passive foreign investment companies, that are held by U.S. persons overseas. Therefore, FATCA at the institutional level has a purpose of gathering information that uncovers the PFICs at the individual U.S. person level. FATCA works because the PFIC at the individual level is taxable at the highest marginal tax rate. The source to find that information is any transfer in U.S. dollars from anyone, a U.S. person or a non-U.S. person. You see, FATCA reporting brings transparent any U.S. dollar transfer, and it brings enforcement to the financial and tax environment for U.S. persons everywhere, in the U.S. or overseas, who are investing abroad. It also brings financial transparency to any non-U.S. person causing a capital transfer in U.S. dollars. And in fact, enforcement has even caused a change in the behavior of U.S. financial institutions who are dealing with a foreign counterparty. Therefore, all U.S. dollar financial institutions are included in FATCA information gathering. And the consequence of FATCA is to find, the unreported income to tax. Now, there's an unintended consequence that arises for those who can find a legal basis to structure themselves to be exempt from transparency. Exemption means secrecy and privacy. Secrecy and privacy? Well, it means a huge savings and administrative costs for foreign financial institutions. You see, the law of unintended consequences arises within FATCA rules because, action often precedes thinking beyond the immediate problem, and the FATCA solution is transparency. I mean, there's no doubt that the United States Treasury felt it was losing tax dollars to individuals and corporations who managed to hold assets in offshore accounts. The unintended consequence is the recognition by FATCA and the U.S. Internal Revenue Service there are certain laws on privacy and secrecy that are recognized and regulated by governments globally. Those privacy and secrecy laws protect the world's largest investors. Pensions. You see, the practical outcome of this webcast is to demonstrate how at both the information gathering level and the cause of current taxable income at the individual tax level, there can be a pension fund of a foreign government that is a regulated, FATCA-registered, and U.S. Internal Revenue Service recognized foreign retirement plan that is an entity recognized at the institutional level annually as exempt from FATCA reporting, and it's an entity exempt from current year information gathering can be a consequence of FATCA for that entity. Now, the unintended consequence of FATCA is that FATCA and the IRS have recognized that income held within a specific type of foreign retirement plan structure has no current year tax at the individual tax compliance level. So this webcast will provide illustration that when there is a legal basis, a FATCA exemption is a practical step for a U.S. person and also, in fact, every non-U.S. person who is investing in anything whatsoever that is denominated in U.S. dollars. But first, let me just take a closer look for a few minutes on this passive foreign investment company issue, because it is the target of the U.S. Internal Revenue Service and is an intended consequence which in fact caused the Foreign Account Tax Compliance Act to be created. You see, knowledge about what caused FATCA before providing the what could be called an oh-so-easy solution. Look, you need to look before you leap before holding assets in a foreign financial institution or a foreign financial entity. So there will be three areas that we're going to cover at this moment. We're going to cover the fact that beware of passive foreign investment company rules. The intended consequence of FATCA is to find the PFIC income to tax. Secondly, passive foreign investment company exemption. The unintended consequence of FATCA is that there is an IRS-recognized and FATCA-registered entity where there can be no PFICs to tax. Third, FATCA reporting exemption. The intended consequence is privacy and secrecy laws that are recognized by FATCA that provides an exemption from FATCA reporting, and even a box to check on IRS Form 8957 and on W-8BEN-E. So the passive foreign investment company, simply stated as PFIC, has no favorable outcomes or planning opportunities, which is why having an exemption is good. So beware of passive and foreign investment company rules overseas, because they are found in any partnership, corporation, IBC, trust, estate, they're in funds, non-compliant life insurance annuity policies, stock in foreign corporations, any pass-through entity that has income, dividends, interest, gains from sale or exchange of investment property, and in fact including entities holding commodities at times. For example, the income that a trust derives from its sale of physical bullion that is expected to be treated as passive income for this purpose. Since substantially all the trust assets in this example will consist of physical bullion, and the trust expects to derive substantially all of its income from the sales of physical bullion, it is expected then the trust would be treated as a PFIC for each of its taxable years. So enforcement of the PFIC tax regime on investments held outside the United States by persons subject to U.S. taxation, it has been light or non-existent in the past, even though the PFIC tax rules have been around since the 1980s. So this is because before FATCA enforcement, then, it relied entirely on self-reporting and therefore was severely limited in its ability to enforce the PFIC reporting rules. Now, of course, the IRS has a way to verify the nature of any offshore investment held by U.S. persons. And a U.S. person, I mean here that a U.S. person is anyone who is subject to U.S. tax, such as obviously a U.S. citizen, U.S. resident, a U.S. visa or green card holder, and et cetera. So the new FATCA law enforces information gathering because reporting is now required by foreign financial institutions. So any financial asset held by foreign structures, trusts, corporations, life insurance partners, which have U.S. persons as beneficial ownership will need to be reported by the financial institutions of the U.S. Internal Revenue Service. So the PFIC regime is massive in scope, and if you can't prove that what you have as an entity is not a PFIC, then it is a PFIC. So on the basis of tax-controlled foreign corporation, which will be seen in the slide, and the passive foreign investment company are actually similar from a tax standpoint. Of course, the filing documents are different. But I'd like to show this slide to show you that really there's not much significance tax-wise between the two, because the tax rates on PFIC are similar to CFC at the highest marginal rate. So there's IRS special filing forms required, which are charged tax at the highest rate on any income from interest, dividends, and capital gains realized within a company or IBC or trust that are considered to be a PFIC. So the cost of the required accounting, record keeping for reporting PFIC investments can easily run into thousands of dollars per investment year. So it might be important to also note that a U.S. taxpayer with even 1/10 of 1% interest in a PFIC is exposed to full compliance costs. So the problem is that many U.S. taxpayers do not choose to acquire interest in a PFIC, but often, rather, the decision to enter into such an investment could have happened, might have happened, often does happen, by the taxpayer's foreign advisor who may be completely unaware of the potential adverse U.S. tax consequences to investors. So, nevertheless, even a U.S. taxpayer with 1/10 of 1% interest in the PFIC is exposed to the full compliance cost associated with PFICs. Thus, even a small percentage of ownership can result in severe tax and reporting consequences. The PFIC rules look not only to direct ownership, where shares of foreign corporations are owned outright by U.S. persons, but also to indirect ownership through foreign corporations, partnerships, trusts, estates that account or certain attributable ownerships, so certain related persons. So the PFIC regime has, again, no favorable outcomes or planning opportunities arise once the holder falls within those rules. So just to remind yourself, the problems with current PFIC rules is that, first of all, the definition of what is a PFIC is overly broad and can capture businesses intended to be engaged in an active trade or business. The application of the asset or the income test in determining when a foreign corporation should be treated as a PFIC, well, it will often result in the classification of it being an active business as a PFIC. Thus, for example, you have an active foreign corporation, has a bad year with low income, or losses from the active enterprise may nonetheless generate enough passive income, such as from a dividend from a portfolio investment, that will cause it to be a PFIC. So additionally, sales and service companies, startup companies, are prone to meet the asset test since they typically do not have significant assets other than working capital, which is passive. importantly, once you're a PFIC, once it's a PFIC, always a PFIC is the PFIC rule. So once a PFIC, always a PFIC rule will further aggravate the adverse side effects of a PFIC. So I don't mind even saying again that the decision to invest in a PFIC, that they sometimes are made, unfortunately, by the taxpayers themselves, but sometimes rather by a foreign investment manager who often may not understand the consequences of this PFIC regime for their customers. So, again, because shares of foreign investment companies, collective investments generally are not intended to be offered to U.S. persons, such PFICs generally do not keep the financial information required by U.S. taxpayers. So there's the difficulty of even reporting something like that is extremely difficult. So finding financial information, I mean, even short-term capital gains, long-term capital gains, dividend, interest, fixed income, what is it is very difficult. So difficulty in obtaining information and reconstructing historical data might be relevant and yet very hard or even sometimes impossible to achieve. So just to kind of end this thought, the PFIC rules are a huge obstruction because those rules actually are an inch wide, a mile deep, and recognizing and reporting of a PFIC is far beyond the scope of this webcast because the focus of this webcast is more on, hey, what about, is there an oh-so-easy solution that would be recognized by the IRS and FATCA, that is registered as exempt on the institutional level, and where the question of, is this a PFIC or not, becomes irrelevant on the individual tax level. Because where there is no PFIC, then there's no PFIC to tax. So just be aware that at individual level reporting of foreign financial accounts and income are required to be reported by all U.S. persons annually to both the U.S. Treasury and to the Internal Revenue Service. And at the individual tax level, there, in fact, is no off-the-shelf foreign retirement plan that qualifies to be exempted from PFIC rules. So later we're going to go into what would qualify a foreign retirement plan, what are the 17 legal points that would qualify a foreign retirement plan to be exempt from the PFIC rules, and we'll be going through those. Therefore, on the individual tax level, a foreign retirement plan can provide that exemption to meet the IRS codes and criteria, and we need to be able to recognize what retirement plan. It's more than just a retirement plan label that's required. So we're going to go through that in a slide a little bit later on about IRS compliance and not being subject to PFIC rules. So to say that in a different way, do not attempt to achieve the results at home alone without experience and knowledge. This presentation proceeds on the basis that individual tax compliance is important. It can be achieved to validate the 17 points of law, which will be shown on the chart later in the presentation, because the path we are going down in this webcast is the exempt path where there is no PFIC to tax. The consequence of FATCA to enforce PFIC rules can become the basically unintended consequence of having no PFICs to tax. But first, at the end of 2015, anybody operating in U.S. dollars must have a FATCA registration and declare every U.S. dollar account in the entire world unless they are exempt. So before we look closely at the application of what is exempt from FATCA reporting, we most importantly need to look at the difference between a capital transaction and a trade transaction, because you see, the Foreign Account Tax Compliance Act covers all U.S. dollar capital transactions, irrespective of whether there is a U.S. person involved or not. If it's a capital transaction, then we need to look at that, and it brings up three issues. Well, the first issue is U.S. source payments from U.S. stocks and bonds. How to deal with FATCA hindrance to direct or indirect capital investments, and the easiest path for direct capital investments in U.S. dollars to verify no secret U.S. connections. So importantly, we're going, in a few minutes, we're going to define the difference between capital and trade. But before we do, let me just mention a few things about U.S. source payments for U.S. stocks and bonds. You see, all financial institutions everywhere in the world receive substantial U.S. source payments because U.S. stocks and bonds are widely owned globally, virtually mostly on behalf of clients who have no connection at all to the U.S. Allowing 30% of those payments to be withheld, of course, would not be an acceptable option. So U.S. source payments need to be looked at because it involves U.S. securities, foreign securities held by U.S. persons directly or indirectly via company or trust. It covers total return swaps or security lending references to U.S. securities, which were previously exempted from withholding tax but now qualify as U.S. source payments. Covers derivatives products, dividend equivalent payments from derivatives, which are referenced to in U.S. securities and are now also treated as dividend from a U.S. source. Therefore, would trigger a 30% withholding tax. So furthermore, 30% of any funds sent from the USA to a non-compliant financial institution would be withheld by the U.S. financial institution. U.S. source is a key issue here because that, in fact, is actually a form of capital control. So how to deal with the FATCA hindrance to direct or indirect capital, because a direct capital investment is most common when there is a company or individual who wants to have some sort of direct investment in U.S. dollars and are with U.S. people. By a direct investment, I mean, for example, going to buy into a U.S. company or a U.S. business partner, or my goodness, the thousands of other capital deals on investing in U.S. dollars that occur daily. In those cases, the U.S. counterparty must be able to verify that the dealing is with a person who himself does not have a U.S. person behind him. So that means, in other words, there is a second administrative layer behind the investment transaction, and when you are not a FATCA deemed compliant entity, you are just a person or entity who wants to do business. Therefore, each party to the investment would need to verify that they do not have a secret U.S. business partner or secret beneficiary, and in order to do so, that each needs to tell the other all about themselves and all the people with whom they are connecting. Well, either may not be able or perhaps may not want to reveal or disclose all of those things, and it might not even be any of somebody's business, so to speak, but each are legally obligated by FATCA to disclose. So that is a problem, and therefore FATCA covers investments where both are a U.S. person, where one is a U.S. person and the other is a non-U.S. person, or where the transaction is simply U.S. dollars. And it even covers U.S. financial institutions as well, and many people do not realize that when involving investment dealings with capital, American institutions are also caught by FATCA, not only foreign financial institutions. So, in other words, we are dealing with capital, then disclosure is going to be necessary, maybe a hindrance, but it's going to hold things up unless it can be accomplished, and to discharge the obligations under U.S. law. And for the non-U.S. person, it holds things up also because we need to know under FATCA rules whether or not, even at third or fourth hand, if this non-U.S. person has any U.S. person connections. So, I mean, the non-U.S. person might declare, well, wait a minute, of course I haven't. Well, I mean, what are you talking about? I haven't got any U.S. persons behind me. Well, his counterparty might reply, well, we have got to freeze your account until you can prove that you are not connected to a U.S. person. I mean, that's where the problem lies for those dealing with direct or indirect investments. So, looking backward at the FATCA exemptions, there are really only a few. They are governments, agencies, and recognized foreign government regulated and registered retirement plans. And these plans were excluded from FATCA's broad rules by a formal determination of the U.S. Treasury 4 years ago. So regulated, registered, and recognized by FATCA retirement plans are of particular nature, and they themselves need to obtain their own FATCA recognition. And when you are in this registered foreign retirement plan, then you are in the clear because you are in the deemed compliant category. A member, therefore, can authorize anyone, it could truly be anyone, to sign a W-8 saying that the investment of capital in U.S. dollars is FATCA compliant with no need to disclose or to not disclose. So in direct capital investing, both sides need to make investigation to each other's background and to make sure there's no undisclosed U.S. persons. With exemption, there is no need to disclose or not disclose if there is any U.S. person connection. Well, why? Because it's exempt. That's why. And later we will explain why that is. But for now, and additionally, there is, of course, indirect capital investing. What happens there? Well, in indirect capital investing, disclosure is a real problem because of the number of transactions and the sheer volume of the information. Going through intermediaries, such as brokers and dealers, intermediary transactions, they must cause real problems. So what's the difference between capital and trade? Hypothetically, direct and indirect capital investing, disclosure is a direct interference to dealing. But if you write that disclosure is a direct interference to dealing on a very large piece of paper, it suddenly becomes apparent that even straightforward trade deals which involve the deployment of capital are going to be interfered with, because the way this thing is heading is that unless you have some sort of FATCA registration, you can't deal in U.S. dollars or with the U.S. person. It's that simple. You can't deal in capital and transactions U.S. dollars or with the U.S. person, which brings up a question. How do you define the difference between capital and trade? Say it's capitalized in U.S. dollars, even $1. It's capital, and therefore subject to FATCA. That's effectively the deep dish effect of this. So David, please, David, tell us, how does FATCA define the difference between capital and trade?
Look, thanks for that, Lon. Unfortunately, FATCA doesn't. The Foreign Account Tax Compliance Act is focused on accounting rather than the legal quality of this type of payment or that. I think all we can do is take a clue from the fact that a passive foreign investment company, the word investment gives us a clue to this. I'm not being legalistic about it, but it's to the point that it may be very difficult to distinguish between what is trade and what is capital in the way of payments. I think that probably it's going to come down to a question of the Internal Revenue Service making further guidelines as people go along. Ron's already alluded to some of the difficulties to do with PFICs, which are deemed PFICs and so on. But there is no clear-cut, bright line between what is capital and what is trade. I mean, obviously, trade involves payments for goods and services. Well, we know all of that, but unfortunately, FATCA is silent on the point. For that reason, one should tend to make the assumption, again, as an unintended consequence for wealth managers, that something is going to be capital rather than trade unless it isn't. So, Lon, what I suggest is that perhaps if you go back to analyzing what FATCA has done in conceptually in dividing the world into different things. Okay.
Well, David, what FATCA has done is, of course, they've divided the world as a whole into three parts. There's two compliant groups, and then there's a third group of rejects. Rejects, that's what the U.S. IRS calls them. Rejects can't deal in U.S. dollars. So what we have in the case of FATCA is that everything is reportable unless it isn't. And that's okay, because then we're going to look in a few minutes at what isn't reportable. So if you're a member of a government-regulated, registered, recognized, and foreign retirement plan that is FATCA compliant, that is the reality. That is the way FATCA works. A foreign retirement plan has been IRS recognized for 30 years, so it's no surprise that it is excluded from FATCA. So there are, of course, four considerations when we're looking at this. People can decide to comply. They can maybe decide not to comply. Is there a way for them to avoid or to be recognized as exempt? Those are all issues that because FATCA covers an extremely wide net. Obviously, all foreign depositories, custodians, investment entities, specified insurance companies all fall under the purview. And investment entities, including organizations participating in investing or administering financial assets for or on behalf of customers. Entities that are customers of yet other financial institutions are no exception, as many investment managers operating in jurisdictions outside the U.S. are given three choices. You either comply, you don't comply, you avoid somehow, or you're exempt. So then there's three issues. The investment entity must decide to comply or not to comply, to avoid U.S. dollar, or to be determined to be as exempt. Both non-U.S. funds and non-U.S. managers must also comply. There's no choice. And then the third issue is, of course, how would a person have a legal basis to be exempt from FATCA registration and reporting? Okay, so there's four considerations: comply, don't comply, avoid, recognize, and exempt. So FATCA is estimated, of course, to affect thousands of foreign financial institutions. According to the IRS, the numbers. In addition to that, estimated tens of thousands of banks, of course, custodians, transfer agents, more thousands of hedge funds, a similar number of private equity funds that's affected by the legislation. Non-participating FFIs, foreign financial institutions, will have limited, if any, access to the U.S. dollar and will be shut out of the securities market of the FATCA-compliant world. So foreign entities operating as a collective investment vehicle, mutual fund, exchange-traded fund, private equity fund, venture capital fund, a leveraged buyout fund, or similar vehicle will be deemed an FFI by the IRS and obligated to comply with FATCA. Hedge funds, whether established as corporations or limited partnerships, generally fall into the FATCA regime and will have compliance requirements to meet. Investment management companies, master funds with U.S. feeders, general partners, even trusts, of course, also will be affected. So with FATCA withholding does not generally apply to withholdable payments made to exempt beneficial owners, and these entities do not need to register with the IRS into an FFI agreement or meet the due diligence and information reporting requirements of FATCA. Their exempt beneficial owners include, to avoid FATCA withholding, an exempt beneficial owner must certify that it is an exempt beneficial owner on the IRS form W8-BEN-E presenting to the withholding agent. So the upshot of FATCA is that it reflects the difference between occupational and not occupational pension plans. You see, it's not just having a label a retirement plan. A savings account in a bank can't be labeled a retirement plan. There is a difference between an occupational pension and a non-occupational pension. And I think, David, again, I'd like to have you explain that difference between what is the difference between an occupational pension and a non-occupational pension, because occupational pensions are recognized exempt, but non-occupationals don't qualify. David?
Well, Lon and listeners, the distinction drawn for FATCA purposes is really very, very important, the difference between exemption and not being exempted, so that for the wealth managers of you who are perhaps involved with the pension business, the word occupational simply means to do with employment, either in the past, the present, or possibly the future, as opposed to something that is purely a savings mechanism or some type of leveraged investment against returns in the future. The other important part about it is that there must be tax recognition of occupational retirement plans, and tax recognition is a term of art in tax law, which is referable to whether or not a plan is on some form of register in any jurisdiction and that is regulated. Either you're on a register or you're not, and if you're on a register that is operated by a regulator, you will become tax recognized in most countries, and the U.S. recognizes this through its program of double tax agreements and also to do with FATCA on what are called intergovernmental agreements. But it is important to appreciate that there's a big difference between pension plans that are to do with work, and everybody can imagine what they are, and those that are not to do with work. The former are FATCA recognized, the latter are not.
Okay. All right, David. I think at this point, what I'd like to do is go to some slides that I have that just basically lay out some of the 17 laws that are required. You see, the point being is I've made a comment that the IRS recognizes in IRC, Internal Revenue Code 402B retirement plan, and the 402B retirement plans can be structured about 9 different ways, and there's about 4 different models of those plans, and not all of them will meet the 17 points of the charts that I'd like to just quickly show. Because we have some other information we'd like to get into here. But the chart indicates, if you look on the far right column, occupational retirement plan, that's referring to a occupational foreign retirement plan that meets one of the requirements of the 402B tax code. It can be structured in various ways to meet the requirements. But if it meets those requirements, then the answers you see on the far right column are the correct answer that needs to be applied to meet the issues that we've been talking about being exempt at the PFIC level, the tax level, PFIC level, and also to be compliant on the institutional level for FATCA exemption. So I think while those slides are just being shown, I'd like to, because of the time involved, I'd like to just move on to the important, I think everybody's been waiting to hear more about secrecy and privacy. And if while people are wanting to look at those charts, I'd just like to continue by saying that, of course, everybody knows banking secrecy is no longer there. That's gone. It's over. It's in the past. Banks' vow of silence was so attractive to rich foreigners eager to avoid taxation at home that they didn't mind that their accounts did not generate even any income sometimes. So that's gone. That's in the distant past. So, but many countries have laws imposing secrecy and on information about pensions. And if you stop to think about this, under FATCA, which essentially by obtaining a GIN registration, it means you give up what you've got, you agree to do that by obtaining a GIN number. So if you are in the category domestically that has a law that says that you can't do that, then to obtain a GIN number would be a breach in law, and to do so would mean you agreed to break the law. So that is why FATCA has what is called a limited conditional category. And David, again, I'd like to call on you to go through that information about the limited conditional category and make reference to the secrecy and privacy that has been allowed for in the FATCA regime.
Sure. Listeners, what is striking about FATCA is that it contains a conundrum, an unintended consequence, not only for wealth managers, but for everybody, because the whole point behind FATCA is disclosure. But you see, most of the world, certainly the biggest investors of the world, are in fact covered by secrecy laws. A lot of people don't realize this to do with pension funds. So you have the biggest investors in the world, in fact, exempted from FATCA. And the way that you look at this, you see a lot of people don't realize this, is you need to define, first of all, if you're a financial institution. Well, let's say you are. And then you need to define if you're a foreign financial institution. Let's say you are. And then you need to decide, and this is the thing, that it's worth having a read of Form 8957. For those of you who don't understand what I'm talking about, it refers to restricted information, in other words, secret information. Now, if you're a foreign financial institution, such as a pension fund that's dealing with restricted information, you do not qualify for a GIN, full stop. Instead, you apply for what's called limited conditional status. If you do that, you're deemed compliant until the end of next year. And that's a good thing, because it means that you are no longer faced with the difficulty of being required to hand over the information that is under your control, the secret information, to the IRS. Now, obviously, there needs to be some mechanism to cope with that conundrum in future, because many countries have these sorts of rules. I can think of, for example, the United Kingdom, which has no less than 20 sections in its own pensions legislation dealing with secrecy. So the idea generally is to deal with it through subsidiary agreements between the U.S. Treasury and other foreign countries, called intergovernmental agreements, to cope with, amongst other things, exactly how information is going to be relayed. And the general idea in dealing with secret information is it stays secret vis-a-vis the foreign financial institution that might be an administrator for a pension fund, it might be a custodian for a pension fund, it might be an investment advisor or wealth manager. So in other words, you have a huge sector of the world's economy which is in fact exempt from FATCA. And as I say, it's important to appreciate that one of the big unintended consequences of this law is it does run up against secrecy laws of all of their different stripes, and we ain't finished yet on how we're going to cope with all of that. Many countries are having to amend their laws, and ironically, the U.S. is almost certainly going to have to amend its laws on secrecy as well. So it's a work in progress, and we will need to wait really for another year or so to see how FATCA in practice plays out in the pension arena. But fortunately, I think that the IRS do understand the conundrum that's there. That is the unintended consequence that I think is probably the most important for all investors.
Excellent. Okay, well, Lawrence, I think, are we ready for a few questions from our listeners?
Excellent. Well, thank you very much for that presentation, Lon and David. I think there's some excellent points raised there, and I think I've certainly learned quite a lot through going through that as well. So there's a few questions come in through the audience, through the webinar. So first of these, I think, general question, I think, with a lot of the rules you talk to here, do they actually affect US domestic institutions as well as non-US financial institutions? I don't know who's better placed to answer that. Perhaps, David, you'd like to pick that first?
Yeah, sure. I mean, what people seem to imagine is that somehow or other U.S. domestic financial institutions are unaffected by FATCA, but of course they are, because it's almost inevitable that if they're dealing either with U.S. dollars or a foreign counterparty, they themselves will need to verify in either case that their counterparty is FATCA compliant. And that's the problem, do you see, Lawrence and listeners, when you're looking at this supposed distinction between trade and capital. And it's because FATCA is cast so widely. So the general approach that I and my colleagues have taken consistently has been that all of our U.S. domestic counterparties simply must be ready to be FATCA compliant as well. So it's a big thing, a really big thing. It's not just confined to some institution in Hong Kong that might or might not have a U.S. person as an account holder at the local bank.
I think that's interesting. I think you draw attention to the point that I think a lot of people see the word foreign and assume that is only non-US. I think you're quite clear that's not the case. Lon, is there anything you'd want to add to that, perhaps?
No, I think that covered it. That's good. Mm-hmm.
Excellent. Well, thank you. Another question that came up through the webinar is actually quite specific, but it's around a company in Hong Kong who's in the process, they've registered with a FATCA GIN, and they're reporting as a Model 2 FFI. So what procedure do you believe that they should be following in this situation?
Sorry, Lawrence, could you just repeat that? I didn't quite catch all of that.
Yeah, so the questions that came through, so it's a company in Hong Kong. What is the procedure after registering for a FATCA GIN and reporting to as a Model 2 FFI? And I think the questions come in light of some of the discussion you've put around the conditional status as to...
I see. I mean, if you've got a GIN, basically what you've done is agreed to directly report to the Internal Revenue Service. Different countries have different approaches. Do you see? Hong Kong has what's called a Model 2 approach, which is direct reporting as opposed to reporting via the local tax authority, which in turn would report to the IRS. The limited conditional status is quite different. It's anticipated, would mean that the local entity, if it was dealing with, as I said, restricted information, in other words, it's under secrecy rules, would not report directly to the Internal Revenue Service. Instead, it would report to its local regulator, in this case, the pension regulator. So there's a marked distinction, Lawrence and listeners, between how, say, a Hong Kong company, and it's the same in many other countries for that matter, is going to approach FATCA. If you've got a gin, you have to hand information over directly, usually or via tax department. If you haven't, and you've got a limited conditional, well, then you should generally be going by your regulator. That's the distinction.
Okay. And I guess that there could be a situation there if someone is reconsidering perhaps that status. Is there any mechanism to take a different path having registered for a gin in either Europe?
Well, there is. Absolutely, there is. There's a very extensive guidelines published by the Internal Revenue Service on how to operate their web portal in these circumstances. Of course, you can change your status. It might affect your reporting timelines. It might affect your reporting content. But the fact is that times change and businesses change. Business models change. So you might start out by being a corporate trustee, for example, thinking that you've gone and got yourself a gin because you qualify as a corporate trustee and you're doing mutual funds or you're clearing or something for securities houses. But what if you're suddenly also dealing with secrecy laws, do you see, because you've wandered off into the area of, say, pension funds or retirement plans or other similar things? What do you do then? Well, FATCA does recognize, first of all, the ability to change, and secondly, there is a clear demarcation in business between what are called limited foreign financial institutions, in other words, limited as to what they can give the IRS, and those that are not. And it's quite possible for a group to be both. So you need to decide how to tackle that. But yes, the IRS does provide for alteration in your circumstances. It's beyond the scope of this webcast to go into the details and things that the guidelines are quite explicit on how to do this.
Okay, that's great. Thank you. That's good. I think you also touch upon there a couple of other questions that have come through here. One of them really is a question around precedents, and Lon, do feel free to weigh into this one as well. And there's a question of when you're in this situation, perhaps, where you have potentially limited FFI status, you're under an IGA, what's the correct order to apply the regulations in? So, is there a flow chart, perhaps, or something we should be guided through here? And should anything else take precedence, perhaps, such as local law in this situation as well? So, I hope that question's clear, but do you want to take a stab at that, perhaps?
Lon, do you want me to cover this?
Yes, go ahead, David. I did want to mention...
I think, Lawrence, the point here is that you first of all need to decide, even if you're changing horses halfway through, your business model, you need to decide first of all whether you are a limited foreign financial institution under FATCA. That's the first thing. And that, in turn, is defined not by U.S. tax law, but by your local law, do you see? So your local law really is the one that's going to be the driver. That's your order of precedence. Am I subject to secrecy laws locally or not? And if the answer is it turns out either halfway through my business model that I am going to be, then I must decide that I am a limited foreign financial institution, and therefore I need to get limited conditional status. The intergovernmental agreements that have been talked about a lot and commented on certainly do have references to different classes of retirement funds. Those are more to do with whether or not there is any particular reporting. So that, for instance, you might very well have a foreign retirement plan with only 2 or 3 members, do you see? And they may have a vested interest in the fund assets. By vested, I mean they really belong to them. And that's quite a common business model in many countries. Well, in that case, you may very well have limited conditional status, but you're not going to be necessarily exempted from reporting the condition of that fund, but not to the IRS directly, to your regulator instead. This is where a lot of countries are going to have to change their laws. It's a more procedural point, Lawrence, there, but it's certainly the case that, in summary, you start with your local law. Am I secret or am I not secret? Then you go on to say, well, if I am secret, do I need limited conditional status? And if I need that, then I look at my intergovernmental agreement, assuming that there is one at all, and I look at whatever that model is, and then I look at the particular class of retirement plan. So it can be quite tedious and complicated for operators of numbers of pension funds. I mean, I'm administering nearly 1,000, so you appreciate that I have some feeling on the point.
Well, I would just like to say at this point that there's a lot of issues that come up when it comes to capital movements, and one issue that we might is the fact that even in the EU directive, which has shut down investing from outside the EU, there is some form of capital control. And now you see the more restrictions on investment by people in the EU now than previously, as a matter of policy, that is effectively shut out because of this directive, the U.S. market out of the EU, unless the U.S. provider is registered in the EU. Yes, you can buy on the New York Stock Exchange, but you may not want to do that. You may very well want to go to your private equity manager or your hedge fund manager in the U.S. and because they have done splendidly well, that you'd like to continue to invest with them. But since the 1st of July, you can't do that anymore because they will run the risk of getting hammered on the regulatory front. So what do? Well, that brings us around to the issue of securities law and pension law, how sometimes those are different. If you can't go direct, you might be able to go indirect under pension law, not under securities law. And I think that's an important issue that domestically things are bumping up against each other all over the world, not just in terms of the U.S. dollar.
Thanks. That's very interesting. From both of you there, I think it's slightly different ways of approaching the question. And I think both of them actually relate very well to several other questions that we had coming through, which I kind of conflate here to one two-parter, I think. One of them quite specific, and is asking whether Hong Kong specifically was going to impose any additional regulations around FATCA or data purity type law around pensions. But the more general question that's come through several times, I think, is how the interplay of FATCA, specifically here, relates with the UK regulations that have recently come out for the Channel Islands and Crown Dependencies. And then with a bit of crystal ball gazing towards the next couple of years to what the OECD are pushing out around automatic exchange of information and common reporting standards. So I guess to sum the question up, and this is expressed in several different guises, so apologies if I'm missing the nuance of some of those that have raised these. Specifically, any likely developments coming through Hong Kong, and more generally...
Sorry, go on.
Sorry.
Go on.
Okay, no, sorry, just take that first part, specifically around Hong Kong.
Yeah, you're going in the grand tradition, Lawrence, from the particular to the general, but that's all right.
Absolutely right. It was partly intentional.
In Hong Kong, the good news is that there's a Bills Committee considering this very point in about 10 days' time. The Hong Kong government is alive to this whole issue of the interplay between secrecy and disclosure. The general policy that they have is that the handing over of any information essentially is going to be very structured, whether it's under FATCA or indeed any other inquiries. It's not that they're trying to hide things or something silly like that. It's just that in terms of delivery up of information, that needs to be structured. The UK FATCA legislation, I think, is going to largely end up being confined to the BDTs, that's the British Dependent Territories, and various associated places, because that's largely been their style so far. It does really become quite awkward under the EU rules to start making your own types of FATCA-like rules and attempting to impose them within the EU, because the EU, as Lance pointed out, they've got their own directives and things there. So I think you'll find that the Brit FATCA style will be confined to the same places that they've been focusing on for exchange of information generally. And as to the future, the OECD have been pushing hard. In fact, they've been pushing since 1988 for automatic exchange of information worldwide. Essentially, the OECD has wanted many jurisdictions to or amend their laws to allow for automatic exchange of information, which is going to be pretty tricky, I would say, by 2016, with real-time online flow of tax information by 2018. So, Lawrence, we are definitely going to be faced with more rather than less regulation.
Yes, I think there's absolutely no doubt on that. And, Lon, you mentioned some of the interplay with some of the European directives on this as well. I mean, anything you'd like to add to that, and how you see things developing perhaps in the next couple of years here as well?
I really don't want to add anything to it other than the fact that pensions are a big portion of the investment money around the world, and I think it's important to look at what effect pension law has on tax law, and if it does, or where it does, and how it does. So I think that's another area that needs to be emphasized from this webcast that needs additional study by the participants.
Okay, thanks. I mean, I think it's a really interesting area. I think it's going to develop an awful lot over the next couple of years. I think we are going to see some inconsistencies, and we see that already with the different variants of FATCA applied to UK and the Crown dependence of overseas territories and the way that the US has rolled it. And within that, there's clear differences to the OECD models. So it's, I think you're right, regulation will increase, and I think complexity will increase rather than decrease. And it is difficult, and I think navigating a path through that is necessary. And I think you give a good view on how we can begin to do that. I think we've got time for one more question here. As I've asked, as we had some rather open-ended ones so far, I think we'll finish with one that maybe has a slightly more yes or no tinge to it. It's come up from the pre-existing accounts. Is it required for these accounts to submit tax declaration forms, and what timescales are people looking at for that?
Sorry again, Lawrence, I couldn't quite catch all of that. There's a which account?
Pre-existing accounts, so existing customers, existing funds.
Yeah.
Is it required for those accounts to submit tax declaration forms, so W8s, etc.?
Well, if they qualify, absolutely. It begs the question of whether or not they will qualify for a W8 in the first place. And in order to qualify for that, the account operator, the institution, would either have to obtain a GIN or limited conditional status. And of course, as we've got limited conditional status, you wander off down a slightly different path. In terms of time frame, usually these things, I mean, it depends on, it's a sort of rolling time frame. It depends on the reporting year, but it's broadly built around the U.S. Both fiscal year and year end. That's 30 September and 31 December. Because it's actually a large question in terms of exactly who the foreign financial institution is, as to whether or not it's classified this way or that. I'm sorry I can't be more specific without looking at the specifics of the account itself, even if it's a pre-existing account.
No, that's fine. I suspect the question was raised with the hope of a yes-no answer. I think one thing that's working in this area for the last 3 years has told me is there is no such thing as a yes-no answer.
Very good.
With any related field. On that note, I think we're right on time. I mean, David, Lon, is there anything you'd like to add to questions, discussions that we've had so far?
No, I think that's fine. We probably don't want to mention my book, I guess. But no.
I think you've just done it there.
Yeah. Okay.
Yeah.
And
Lawrence, I would just say that secrecy laws are going to remain extremely important. People are not going to give up these laws simply because of tax flow information's required. They will remain terribly, terribly important. They're there for a reason. And that's probably going to be the area of conflict in future.
The white paper.
Great. Thank you. I think that's a good note to finish on. So, David, just remains for me to say thank you very much, David and Lon, for joining this. There will be post-event communications on this, and they will include the presentation materials here. We'll also follow up with a white paper, which includes many of the points raised in here, and it would include contact details for all of us involved in this as well. So if we do want to follow up, if you want to follow up with any of us, then please feel very free to. So, David, thanks again.
Thank you.
You're welcome. Thank you. You're welcome.
And wish everyone on the call a very, very good day. So thank you for joining us. And,
all right. Goodbye. Have a nice day.
Yes. Goodbye.